I mean, just imagine, we've had this enormous boost in the quantity of money. Can you really see the authorities deciding this is the wrong path to go down, this is going to destroy the currency, we must stop printing money? No, they will do it again. What we're looking at in terms of banking is actually a rolling crisis, which could threaten to really fall apart at any moment. The first people who will realize that they shouldn't be holding dollars and would be far better stockpiling commodities are the foreigners. And China is already doing this. There is a big difference perhaps between gold and silver in that what's driving gold is the bullion banks are horribly short of futures on COMEX. They have managed to reduce the level of open interest, but they haven't managed to close their shorts. And now we have this today with gold breaking out. Open interest is picking up. Suddenly, they really are caught. And it won't be very long before that 37 trillion becomes 40 trillion, 45 trillion. And then, in my view, we will find that bullion banks are in desperate trouble and will need rescuing or will go to the wall. And of course, if they go to the wall, what does that do to the gold price? It pushes it up even more. We could get a complete failure of the market this time. And I think that because of the lack of liquidity in silver, the bullion banks will have to try and keep their books as balanced as they possibly can. So any buyer comes into the market, it's bid only. It's a bit like that. And I can see this price running up through 30 bucks very, very quickly on this move.
Welcome back to Liberty and Finance. I'm Reluctant Preppers. We have a returning guest that our viewers appreciate to no end. This is Alasdair Macleod. He's the head of research at goldmoney.com. He joins us this Thursday, October 5th, 2020. Alasdair, as always, thanks for joining us here.
Thank you for asking me, DK.
We have to keep you coming back on, for one thing, because you made the provocative assertion in third quarter that you were expecting to see a potential banking crisis in the third quarter and a fiat crisis in the fourth quarter. Arguably, some of those things have continued to build to a head, and we'd like you to bring us up to your very latest. You just wrote an article about the crisis brewing in three major world currencies. Could we start off that, since it fits right in with your prior thesis of coming fiat crisis?
Yes, sure. The three currencies which I wrote about, all available on Gold Money's research insight site, as it were, are the dollar, the euro, and sterling. I'll start with the dollar because that really is important at the moment, with the election being somewhat hung. And today we're talking ahead of the statement from the FOMC, who are completing their two-day meeting today. And the thing that's interesting about that is that the FOMC will be worried that there is very little fiscal help that can be given to the economy while this presidential election mess is sorted out. I mean, it looks to me as if nothing's going to happen for some time. I'm sure the members of the FOMC can see that as well. So the burden of rescuing the economy from whatever devils and dragons you think might be there will fall entirely on the shoulders of the FOMC. So the statement later tonight, which by the time this is released you will all know, is going to be very important. Let me retrace a little bit. The background to the problem is that before the COVID crisis came along, in the last fiscal year, the US economy was running for a budget deficit of around about $1.1 trillion. Exactly halfway through the year, there was the shutdown on the 23rd of March. Since then, the deficit has rocketed to $3.3 trillion. Now, if you allow for the fact that in the half that's just finished, there's roughly $500 to $600 billion was already planned, you can see the excess on top of that was very, very substantial. If you analyze it, basically, in the second half of this year, the US budget deficit has been growing at a clip of over $5 trillion. Now, that was just on COVID-1. We now have COVID-2. I think we will probably get an announcement about accelerated QE to ensure that nothing falls over COVID-2. But if we go back to COVID-1, I mean, for goodness sake, the total expenditure, government expenditure, was in the order of about $3.3 trillion. So you can see that already they are printing more money than they're receiving in taxes. Now, this is a Weimar situation, basically. And here we are with the Fed having to go in again to try and rescue the situation. Now, I concluded in my article, which was about 3 weeks ago, that the dollar actually is already in hyperinflation. The key thing is, how do you define hyperinflation? The way I would define hyperinflation is that the increase in the money supply has gone beyond any control of the authorities. I mean, just imagine, we've had this enormous boost in the quantity of money. Can you really see the authorities deciding this is the wrong path to go down, this is going to destroy the currency, we must stop printing money? No. They will do it again, and we'll have confirmation of that later on this afternoon. Now, there is in the background another problem, and that is that the comparison between what's happening today, if you just put the whole COVID thing to one side, the comparison of what's happening today compared with what happened in 1929 to 1933 is really extraordinary. And I published an article later today. It'll be released within a couple of hours, I should think, which shows a chart. And just it's extraordinary how closely this market, the equity market, has tracked the Dow Jones index between sort of 1922, 23 through so far to 1930, into about the middle of 1930. We had the peak in January, late January, early February. We had a 33% collapse, exactly what happened on Wall Street in October 1929. We have had a bounce, which has now been running for, it's about 6 months, 7 months, 8 months maybe, exactly what happened on Wall Street. And what we need to do is to have a look at why we've got almost a sort of to the letter repeat performance of what happened 90 years ago. And the answer basically is quite simple. At the end of the 1920s, the Roaring Twenties, bank credit had expanded very, very significantly. And it was around about 1929 that expansion of bank credit came to a halt. And at the same time, in October 1929, Congress finalized and passed the Smoot-Hawley Tariff Act. And what has America been doing in the last 2 years? Putting up tariffs against the largest economy in the world, the two of them going head to head, China and America. It's exactly the same story. And if you can imagine that there is a synergistic effect between the end of the bank credit cycle and the contractory phase starting, and at the same time trade tariffs, you can see that this is a very dangerous situation. The way the market has behaved is just absolutely, it's a real doppelganger. The only real difference is that back in 1929, stock prices were increasing priced in gold because the dollar was on a gold standard. So effectively, the prices were in gold. When the thing collapsed, it just went down and down and down and down, as we know, and eventually it lost around about 90% of the value from the very, very top in 1929. Today, we have unbacked fiat currency. So what has happened is that we have followed the track very, very closely with the initial 33% collapse, the recovery, and then we've sort of moved sideways. We're running out of momentum. This is in fiat dollars. Now, the key to it basically will be when the Fed can no longer support treasuries by printing fiat dollars, at that stage, the valuation in equities will return back towards the fundamentals. And as we know, the fundamentals in the economy are deteriorating very, very rapidly. Because it's not just about stock markets. If you look at what happened back in 1929-33, stock market first, and then you had the slump. What the Fed will be trying to avoid is two things. Firstly, financial asset prices falling and killing any wealth effect. And secondly, what they will be doing is they'll be trying to stop the economy going into a slump. So what does that mean? After COVID-2, we're going to get even more QE. So you can see how it is going to destroy the dollar. Now, at some point, it will be understood, I think initially in the foreign exchanges, what is actually happening to the dollar. And you must bear in mind that foreign ownership of dollars and financial securities is in the order of $27 trillion. Those are the most recent figures we have. $27 trillion is about 1.3 times US GDP in 2019. US GDP is down a bit from there, so it's even a bit more top heavy. Now, to have foreigners own so much or be so exposed to dollar financial assets and the dollar is a very dangerous situation. Why? Because they're going through exactly the same problem, and having lots and lots of dollars, having money stuffed into US treasuries, money stuffed into US equities is a luxury for these foreigners. They face the slump as well. So what happens is they sell the things they don't really need. So what I can see is that the first people who will realize what is happening to the dollar, what the Fed is doing, and what the future purchasing power of the dollar is likely to be, and the value of the assets, which at the moment they have tied up in the dollar, are the foreigners. So in my view, the first effect we will see is a collapse of the dollar against other foreign currencies. Now, foreign currencies have exactly the same problem. And if you look at the trade weighted, we're then looking at the euro, because that is the principal currency against which the dollar is measured in the trade weighted index. They have problems. They have a banking system which is absolutely riddled with bad debts. They have zombies. I mean, the economies in the Eurozone are zombies. They really are. I mean, the companies are zombies there. They are complete zombies. And if you look at the Italian situation, for example, I mean, it wasn't all that long ago that we could see that the level of non-performing loans, in other words, bad debts on the balance sheets, was extremely high. I can't remember the figures. It's something like 30% or something of all loans. I mean, it was huge, absolutely huge. The way they have dealt with that is very interesting. What they have done, the local regulators, bank regulators, have said, we will deem these loans to be performing. So they can then use as collateral by the Italian commercial banks to give to the central bank, the Banca d'Italia, as collateral against loans. So that what's happening is that these bad debts are being moved out of the domestic Italian situation into the Target 2 settlement system, which incorporates all the national central banks, headed by the ECB up at the top. Now, the bad debt situation is absolutely enormous. And if you look at the amount of money that is owed to Germany, which is basically what's happened, it hasn't, the money has not been paid through because there's an accumulation of bad debts. But on the Bundesbank's balance sheet, what has happened is they are now owed a total of about 1.2 trillion euros through the Target 2 settlement system from all the other national central banks and indeed the ECB itself. They have a problem because they can see that these balances are now getting worse and worse and worse, and a lot more rapidly as a result of COVID, whatever you like to call it. I mean, the appalling performance of the Eurozone economies. So there they are with these huge, great amounts of money owed to them. And on top of that, the way they are compensated if the Target 2 system falls apart is all that debt is wiped out, And then they have a liability of 400 billion euros on current numbers to pay back into the system. So they go from being owed 1.2 trillion to owing 400 billion. Now, as you may imagine, the people in the Bundesbank in Frankfurt must be absolutely terrified of this situation. What can they do? I mean, can they go along and tell everybody this has got to stop? No, for the very simple reason that if they did that, the whole system would immediately fall over. They've got to keep quiet. Now, that is a problem. Now, as far as the value of the euro is concerned, initially, it won't have an effect because people are not really long of the euro. That's the first thing. What we're seeing is money being repatriated, perhaps, out of dollar accounts by Eurozone banks back into their own balance sheets in euro terms. We do not have the situation of, hedge funds and all the rest of it being short euro, long dollars, or the other way around. I mean, they're just not in this game at all. So consequently, the trade surplus that the Eurozone has with America is probably the main driver at the moment of the relationship between the euro and the dollar, insofar as there is always, you've got this background, if you like, of net exports to America, which means that there is always demand in essence for euros relative to dollars. So that situation at the moment pertains. At some stage, and I think it is after the dollar has had a very bad hit, then you will start getting people really worried in Frankfurt, which is where the ECB is based. You can see the stories starting up about how we need to have a competitive euro because this is just killing our exports and all the rest of it. So you can see how that sort of story gets going again. Now, I don't know how long it will be before that starts happening because we've got this other problem, because while the commercial banks have pushed out a lot of the bad debts into their national central banks and therefore into the Target 2 system, this COVID crisis is basically bankrupting their clients. So they're getting a new wave of bad debts. And they are so incredibly highly geared, particularly when you look at the relationship of the capitalization of the banks to their total balance sheet assets. And I mean, it's slightly better now because bank shares in the Eurozone have recovered a little bit. But at one stage, we had Crédit Agricole. Was it Crédit Agricole, Bank Paribas? That sort of bank. You're looking at 140 times the balance sheet total being 140 times the bank's market capitalization. I mean, these are huge, huge, huge levels of operational gearing as far as shareholders are concerned. So I think it's only a very short matter of time before we do have a banking crisis. I would have thought it would happen now, but basically behind the scenes, and this is something we never really see, there have been support operations going on all the time. And I would remind your viewers that if you go back to September last year, we had the Repo Crisis. And I think that was the first instance of real problems starting in the banking, if you like, in the sort of international banking network. Because that indeed, the September date when the repo rate ran up to 10% was the day in which, coincidentally maybe, Deutsche Bank finalized its sale of its prime brokerage to BNP, Banque Nationale de Paris. So, it could be that various of the customers, like hedge funds and all the rest of it, who maintain balances, didn't take their balances across. One of them might have got into a bit of difficulty, needed bailing out, which they would have done through the repo market and so on. So you can see that what we're looking at in terms of banking is actually a rolling crisis, which could threaten to really fall apart at any moment. But absent that, what I would concentrate on is the fact that the Fed has to print enormous amounts of money to stop what we're seeing today continuing along the 1929 to 1933 crisis path. And that is even if you don't take into any account COVID-1, COVID-2. So that's where we are with the dollar. And I think I've sort of brought in the Eurozone with it, because when the Target 2 system falls apart, I think the whole European the Eurozone system falls apart as well. And then you've got the question of the currency. I mean, you've got you've got huge amounts of debts and irrecoverable deposits in the currency. So I think that confidence in that currency is likely to go very, very rapidly. And then sterling, if you like, is caught in both camps, because we are very heavily exposed to Europe. I know we're sort of completing Brexit and all the rest of it, but we haven't actually got out of the financial arrangements between London and Europe, both on the governmental side and also, probably more importantly, in terms of commercial banking relationships, because the systemic risks that we have in our banks emanating from banks which are far weaker in the Eurozone are extremely large. On top of that, we've got the problem that two of our major banks, Hong Kong Shanghai Bank and Standard Chartered, are very heavily exposed to Hong Kong, and the growing financial war, if you like, between America and China. And that could be very uncomfortable for those two banks. Other than that, our other banks like Barclays, Lloyds, are all operationally highly geared, particularly when you take into account what the regulators do not take into account, and that is the market capitalization relative to balance sheet assets. And in the case of Barclays, you're looking at something like 60 times. I mean, this is actually very fragile stuff that we're talking about here. So we've got all that on one side. On the other side, we have got an economy without savers, with the COVID problems. We do a lot of international trade, which has been contracted and hit very, very badly by the trade war between America and China. We have had to sort of come back from a developing relationship with China, because America has insisted that its strategic partners, the Five Eyes partnership, which is an intelligence operation of which we are part, stop dealing with China. So we've cut Huawei out of our 5G network, all that sort of stuff. So the promise that we could actually do an awful lot for China, which New York refused to do, that promise has gone out of the window. And here we are embarking as an entrepot center for the rest of the world at a time when the rest of the world is just drawing in its international horns. So we have the threat, the same threat as America has, but for slightly different reasons, of that 1930s slump ahead of us. So the Bank of England has already done one round of QE for COVID-1. This morning it announced a second round of £150 billion, which in my view will not be sufficient for COVID-2. And then you got the prospect of further rounds of QE to stop the economy going into a slump. So that's a quick sort of roundup, if you like, of the three major currencies. Smaller currencies, when the big boys fall over, I think they are in trouble as well. Maybe not all of them, but certainly the vast majority of them.
There's a couple of things you mentioned in there I wanted to touch back on. One, when you mentioned that in the U.S. dollar, you foresee that the first perception of the fragility of the dollar will actually come in the eyes of foreign holders of U.S. dollars. And I thought, that's very interesting. So often in life, you think if you really want to know what's going on, if you really want to know the situation on the ground, go talk to a local. You've got to talk to a local because they're the ones who really know what's going on. But in this case, it seems like the emperor has no clothes, but it's going to be the boy out on the edge of the crowd, not the crowd itself. Here in the U.S., that's going to see that as clearly as they need to first.
Well, what I would say there is, I mean, it is likely to be a two-step process. The first people who will realize that they shouldn't be holding dollars and would be far better stockpiling commodities are the foreigners. And China is already doing this. In fact, after the March announcement by the Fed that they would do whatever it takes to rescue the economy, the Chinese then changed their attitude towards the dollar. They then decided that the stockpile they had was dollars, which they didn't want, And actually what they needed to do was to get that stockpile down. In other words, dump dollars for commodities. And they have been doing that. And I don't know if you've seen the copper price, but I mean, that's recently been hitting record highs, which I think is a pretty good indication of where the Chinese are coming from. That is the first step. So we're seeing the foreigners doing the sort of crack up boom thing, as it were, get out of it, sell the currency, just buy anything. It doesn't really matter, copper, lithium, whatever, we'll just buy it sort of thing. Chinese are already there. Other foreigners will be following suit. The people who are last to understand this are always the people who use the currency day to day, I'm coming to your point about, if you talk to the locals, you're going to miss the point, because they are always in these instances the last people to understand what is happening to money. There comes a point, however, where they realize it's not prices going up, but it's money going down. Now, as soon as the population understands that, then they will get rid of that currency as quickly as they can. Any credit they've got, they will draw down on just to buy things and not to have any money. So, I mean, this is what they call the crack-up boom in the European inflations in the early 1920s, and it happens every time. And this is why I think the people who will understand it last will be the actual users of the currency. And it's the same in this country, and it'll be the same in the Eurozone.
Will during that crack-up boom, will that be spun by the official mouthpieces to say, oh, look, this flurry of economic activity, people are buying things once again, we're back off to a super V recovery?
That's a very interesting question. Because you're touching on another point, which is actually very important, and that is what is GDP, which is, as far as the officials are concerned, the measurement of success of stimulating the economy. All GDP is a total, that's the money total, the total expressed in monetary terms of all transactions in a period of time, usually taken over a year. It is not a measure, if you like, of economic progress, which people think it is. It's not that at all. So it stands to reason that if your starting point, let's say in 2019, is a GDP of $21 trillion, if you add $1 trillion into of extra broad money into the economy, then that's going to go to 22 trillion. Or it will do once it all filters through and everybody has ended up with some of this money, rather than it, say, sitting in a bank account or being invested into industry or something. So what we're likely to see is not necessarily a complete collapse in GDP. I think far from it. You'll see GDP actually rising, but the level of unemployment will be rising as well. Prices will be rising. And of course, the other thing is that they make the mistake of trying to define inflation as a rise in prices. And what they do then is they take nominal GDP and then adjust it for the rise in prices. Now, the way in which they have allowed GDP to look really good is by suppressing the level of price increases. And we've had this debate before about, Chapwood Index, shadow stats, how they're coming out consistently with anything between 7 and 10% inflation every year, more or less, since the initial effects of the great financial crisis worked out. But if you look at the way prices have gone, and you applied that as a deflator, the US economy and our economy has been in a slump, really, for the last 10 years. It's gone absolutely nowhere. It's gone down, adjusted by that. But I would argue it's a pointless exercise in adjusting GDP by some sort of price inflation index. What you really ought to think in terms of is that if you understand that GDP, you start with a figure, let's say, for a particular year, and then if you print an amount of money and issue some more credit into the basic economy, that adds to the total of the previous year. It might take a little bit of a pause to work through. So what I would say is that the problem that we have will not be replicated in a falling GDP, a substantially falling GDP. I mean, there will be, bumps and all the rest of it. But basically, because they're printing money in huge quantities, and the purchasing power of that money is going down, in nominal GDP terms, it will appear as if everything is all right. But as I say, you'll find that prices are rising, unemployment is high, industries are going bust, and all the rest of it. Yet GDP is rising. So the answer to your question is almost another question. Can they really claim that when the economy is in such a mess, with businesses going bust, high levels of unemployment, heading into all the characteristics of a slump, apart from that one thing? The money total looks brilliant. Why? Because we've issued more money. It's not a way to measure an economy. And unfortunately, everybody thinks it is.
One more thing you mentioned a few moments ago was about the Italian and other European banks bundling up their non-performing loans, their bad debts, and shifting them over to a different set of books, and so that they're packaged. Now they can be counted as an asset, or it's like, oh my gosh, alarm bells were going off in the back of my mind about the mortgage-backed security crisis that led to the great global financial collapse. How similar, you were pointing out similarities, how similar is that that magic trick of taking things that are known to be toxic and bundling them up and suddenly calling them assets?
I think there's one big difference, and that is that the bundling up of liar loans and all the rest of it was essentially something that the private sector did. It was the banks, the commercial banks, and the mortgage companies, and the residential property industry in the wider sense. And they managed to kid themselves that this was a good idea, and they managed to get people to buy into it, invest into it. This problem is not a private sector problem. When you look at the Eurozone, it is actually a government problem and a central banking problem and a regulatory problem. It's basically all the elements of government have conspired together to bury all the evidence that anything is wrong. And guess what? Target 2 is such a huge, amorphous thing that so few people understand. We found a way of pushing it into that, and it's disappeared like magic. So, the principal difference is that the run up to Lehman was actually a private sector thing.
Well, I guess this is part of we've had some guests on who've said that we're in much worse shape than we were, some by an order of magnitude, than back before the global financial collapse. That it was, in fact, now we've got derivative exposure greater than then. We've got more fiat money that's papered over things greater than then. We've had other guests on say, no, actually, the things are healthier now than they were then, and my jaw just drops, because this sounds like another example of where maybe you can say, look, I cleaned up my room, Mom. Just don't open that closet over there, because everything's going to come crashing down if you do.
Yeah, but it was even more than that, DK. I mean, sort of having stuffed everything into the cupboard. We're looking at two different classes of people stuffing things into the
exactly.
cupboard.
That's the added order of magnitude is up into a whole other realm.
It probably explains. I mean, I think the point you make is an interesting one. I think it probably explains why some people think, well, things aren't as bad as they were last time, because they're only looking at one aspect of it. Okay.
One more thing we wanted to touch on before we get to viewers' questions with you, and that is that after a dramatic run-up, which brought new all-time nominal highs for gold in the summer, as well as a very vigorous move up in silver by over 50%, almost doubled, in a year's time. Now we've seen this consolidation phase. It's this cone-shaped. Some people call it a coiled spring. Some people call it. There's different technical terms. They say it's building pressure. It's going to break out one way or the other. We're seeing what may be a breakout to the upside. Can you talk to us about what's driving that, not just for gold and silver, but also for cryptocurrencies?
Yeah, sure. There is a big difference, perhaps, between gold and silver in that what's driving gold is the bullion banks are horribly short of futures on COMEX. When I worked it out on the last commitment of traders figures, which were for a week ago last Tuesday, it appeared to me that their position was a net loss between all of them of $37 billion. The gross position, in other words, if you look at the total of their shorts and disregard their longs, the net position is in the order of about 52, 53 trillion Now, this is split, I think, between about 30 odd banks. I mean, so we're looking at an average loss of well over $1 billion each. Now, that's an average loss. Some will be a lot less and some will be a lot more. But you can see the problem that they have got. They have managed to reduce the level of open interest, but they haven't managed to close their shorts. And now we have this today with gold breaking out. Open interest is picking up. Suddenly, they really are caught. And it won't be very long before that 37 trillion becomes 40 trillion, 45 trillion. And then, in my view, we will find that bullion banks are in desperate trouble and will need rescuing or will go to the wall. And of course, if they go to the wall, what does that do to the gold price? It pushes it up even more. We could get a complete failure of the market this time. And I think that we had big warning bells on this way back in March because they managed to push the open interest down from something like just under 800,000 contracts down to around about 450,000 contracts and push the price of gold down from, I can't remember the figures, I think it was around about 1,700 down to below 1,500. And then what happened? It just exploded and we had $90 premiums on COMEX and all the rest of it. So that was, if you like, when it broke. Now, fortunately, what they did was they blamed it on COVID. They said, well, the refineries are shut down and so we can't get any gold into the market and, some of the mines are shut down and, but don't worry, boys, we've sorted it out. And they were actually telling white lies about the quantity of the amount of liquidity. The LBMA were openly saying that there's no problem. We've got record amounts of gold in the London vaults. What they did not tell you was that ETF holdings were increasing at pace. You also had private individuals. And a lot of that was central banks as well, because they were including all the Bank of England stuff in that. So if you looked at the actual amount of liquidity in London, it was virtually zero. In other words, all that gold was pre-owned one way or the other. Now, you could persuade maybe a central bank to lend some gold into the market. And I'm sure there was a bit of that going on. And this is how some of GLD's gold actually is held in the Bank of England vaults. Why? Because the source of it must have been one of the central bank safe custody clients being persuaded to help out the market and supply a bit to a market that was short. So that is the situation with gold. Silver is rather different. The bullion banks are short of silver, but not nearly to the same extent that they're short of gold. The problem really is that I think something like over half of the silver in the London vaults is actually held by ETFs. And people are buying ETFs and there is no liquidity. And I understand also that the refiners and processors have decided, that they have been helping out the gold market and, put to one side the refining of silver. So the supply coming into the market, if you like, in bullion form, has also been restricted from that effect. And at the same time, we see that the consumers of silver, who basically are industry, solar panel manufacturers and all the electronics, all the rest of it, and biocide people, they have been drawing down their stocks actually in the London vaults. So you can see that there is a real squeeze there. The nature of it is very different from gold, but it is interesting. And I think that because of the lack of liquidity in silver, the bullion banks will have to try and keep their books as balanced as they possibly can. So any buyer comes into the market is bid only. It's a bit like that. And I can see this price running up through $30 very, very quickly on this move. The last category, I think the only cryptocurrency I really can comment on, and that's not really with very much expertise, is Bitcoin. And Bitcoin, as we look, is trading around about $15,000 for one. I mean, what's interesting is that the people who have bought into the Bitcoin story have done so on the basis that they have had it explained to them what governments do with fiat currency. So they are the earliest ordinary people, if you like, who understand what the Fed is doing. There will come a time when the wider population understand, and we're going back to the crack up boom. When people suddenly realize, it's not prices going up, it's the dollar going down. I've got to get rid of the dollar because it's not going to stop. The first people to recognize this, I think, are the Bitcoin adopters, because they've already had this drummed into their heads as to what is happening and why they should hold Bitcoin as opposed to dollars or euros or pounds or whatever it might be. So it's an interesting one. The other thing is that I personally would not view Bitcoin, or any cryptocurrency for that matter, as currency in the sense that gold, silver, or even a fiat currency is, because you've got to have two things. You've got to have the ability to handle billions of transactions a second, which you can't do with cryptocurrencies. And you've also got to have, the adoption, if you like, right at street level. I don't mean, sort of, I'm going to buy something from Amazon or Jack Ma or whatever, using Bitcoin, but actually to do it at street level. And then if you're going to do that, you need technology. And that, I think, is an encumbrance. So I don't actually see cryptocurrencies, and particularly Bitcoin, as anything more than a store of value while you have a collapse of paper currencies. But I don't see it being used as money subsequently. So what that means is that when paper currencies have gone, I think we're then looking at a question, and that is, do you price Bitcoin in gold, or do you price gold in Bitcoin? In other words, which is the money? And then I think when you sort of think through that, it becomes absolutely clear that the only money is the one that has survived for 5 millennia, and that is gold or silver, or even for very small transactions in the absence of paper money, copper. So, but where that leaves Bitcoin until that happens is we have the potential for the most enormous bubble you have ever seen. I mean, just imagine the South Sea bubble in London. If you were going to participate in that, you would either have to have a goldsmith banker, for example, who would be prepared to lend you the money, and that wouldn't be easy to come by. Or you had to get into your coach and four and ride into London with your treasure chest with you, risking the highwayman and everything else, to make a deposit so that you can go and buy South Sea shares. Despite all those encumbrances, this was a bubble of historic proportions, and the emotion that went with it and all the rest of it. Now, switch to Bitcoin. That we've got 7 billion people, the majority of which have a data-capable mobile phone. These are all people who can participate in Bitcoin, and they can buy the tiniest bit. They can do a Robin Hood and buy the tiniest bit in order to benefit from it. And this, to me, is the potential for a bubble which is probably greater than anything we have seen in the middle of a fiat currency collapse. I mean, these are truly extraordinary times, DK. I mean, it is really remarkable. So those are the three things: gold, silver, and Bitcoin.
If we could turn our attention to some viewers' questions. We only have a short period of time left, but if we could, we have one from Ayub Ahmed. He talks first about the Brexit outcome and the British Financial Centre. I think you've discussed that already. But then he turns his attention, could Alasdair shed some insights on how LIBOR is going to turn out as we're phasing it out in 2021? We've heard from various commentators about the potential disruptions that will come with the end of the system for fixing interbank lending rates. Could you tell us what people need to keep their eyes on about LIBOR and what you expect the outcome of that to be?
Well, I think actually when we're talking about LIBOR, what we're talking about is phasing it out as the basis of valuation of derivatives and various other things. LIBOR will continue to operate because it is the way in which commercial banks swap liquidity. So if at the end of the day you are short of liquidity, then you go into the LIBOR market and you find a bank who will lend you that money. So it is, if you like, the rate of the wholesale money market. So it will continue to exist. What they're trying to do is to remove it as the basis of valuation for derivatives and things like mortgages and so on and so forth. And the reason for doing that is because of the scandals we've had with people fixing the fix, if you like, interfering with the fixing process in order to get a result. And if you can move the daily fix by sort of 1 basis point, I mean this is worth almost billions, if you like, in terms of change of valuation. So very, very good for some and not good for others. So you can see the incentives, if you like, to try and fiddle the system.
We have a question about, it's still related to debt and rates. Glenn Sibiston asks, does increasing debt cause commodity price volatility? An example that comes to mind is global oil producers responding to low oil prices by increasing production to service debt and thereby decreasing price further. So you get this runaway, or absent a debt, more reasonable response to low prices would seem to be reduce or halt production to conserve the resource. Are precious metals somewhat resistant to this phenomenon?
I would say it's not a link I would really look at. Obviously, with so much debt, I mean, debt is the other side of bank credit, of course. With so much of that around in the global economy, producers of anything basically have debt, and an awful lot of them have debt which they probably don't ever intend to repay. They would hope they could roll it over, for example. And I think that an oil extraction company in that position certainly does have problems. They've got to be able to continue to roll things over, but then they have another problem, and that is that the world is, for better or worse, moving away from fossil fuels. And so the long-term outlook for some of these potential oil fields are not nearly as good as it was. And this matters to a bank lending money to an oil exploration company. It matters, if you like, when that oil exploration company is trying to raise debt in the capital market. So I think that is almost a separate problem, if you like. And I wouldn't say that there is much volatility in the price of oil which originates from various producers being over-indebted. I think that's a link I wouldn't make. I think, we've got volatility. Yes, we have. But the volatility was very much financial from a different direction. I mean, you may recall that back in April, WTI went negative, which is just completely extraordinary. And now I see, I'm just looking on my screen, it's trading at 38.82, having been up around about $40. What really matters, I think, is the purchasing power of the dollar. I could see oil being roughly the same price in real terms, in terms of the goods and services and so on that a producer of oil can buy out of a barrel of oil. But it's that intermediate bit, it's the money that creates the link from producing the oil, selling the oil, and buying the things that you need, if you like, to put back into the business or to pay staff or whatever. It's that dollar. That dollar can go down the pan. And that's what I'm saying I believe will happen. While the purchasing power of a barrel of oil, if you like, look at it in terms of gold, probably go down a bit, because when paper currencies collapse, the purchasing power of gold goes up in its own right. But basically, the medium which is undermining the whole thing is the dollar itself. And that's the thing, I think, to watch, rather than, debt levels of producers and things like that.
I guess we should probably at least acknowledge that either households, individuals and households, or industries or countries that rely on high or unbelievable debt loads reduce their ability to weather upsets, and they sometimes don't have the optionality that people do who are standing on a firm, solid foundation of not being dependent on that debt collar around their neck. So.
Yeah, a country which has a lot of debt generally has less room for maneuver. But I think the key thing to look at is, the propensity to save. Let's put it that way. If the citizens actually are savers, then the level of debt doesn't matter quite so much, because what they're doing is they're not driving the economy by consumption, they're driving it by saving. Now, what that means is that they are providing the capital for their industry, maybe even their own government to borrow, in order to improve the overall output of the economy. And the prime example of this is Japan. Why is it that the Japanese yen is so stable? Because the Japanese are savers. I mean, when the government tries to print money, what happens is that the savers go and buy the bonds. And if let us say the Bank of Japan is in there doing QE, then the savers go and invest the money in industrial production somewhere. And consequently, you have a situation where you've got enormous stability, not rising prices. The purchasing power of the yen seems to hold itself extremely well because it's not being chucked out in useless consumption, but instead it is expanding the productive capacity of the economy. Very, very different from America and Britain, who followed the Keynesian course, destroyed their savers and the savers' desire to save. I mean, beyond pension funds and insurance policies and things like that, which are almost mandatory for us to invest in. We've got almost no choice in that. I mean, who's got savings? I mean, in your country and my country, they say that something like 80% of the workforce lives from paycheck to paycheck.
Which ironically over the past several generations has been held up as a patriotic thing to do, is to not, because those who are savers are considered, they're hoarding, they're squirreling away money, they're taking it out of the economy instead of spending it. There was even spend a dollar, save a job. I can't remember these various slogans that have been brought out.
Yeah, but that's people buying the Keynesian Kool-Aid, basically.
Right.
But you just have to look and see, how is the Japanese economy performed relative to the American economy? How is the Chinese economy behaving relative to the American economy? I mean, Chinese save some incredible amount. I mean, something like 40% of their after-tax earnings they save. Germany is exactly the same. Germany still has a savings culture, despite all the destruction of the euro and so on and so forth when they moved into the unified currency. I mean, the evidence is quite clear. If you have an economy driven by savers, it's going to be far more successful than one driven by consumption.
One final question, if we could, from Broadsword Calling. He says, are there any economic lines in the sand where the system has to fail mathematically, such as debt to GDP ratio, nationally or globally, of X%, negative global interest rates, etc.?
No. Simple answer. It's down to human action. It's down to all of us, how we respond to events. We have greed and fear and all the rest of it, and that cannot be controlled by government. They try and manipulate it, obviously. But at the end of the day, you cannot arrive at a mathematical solution to an economic problem. And it's where the whole system has gone completely wrong. I mean, ever since Keynes, who was a mathematician, not an economist, redefined economics in terms of macroeconomics and mathematical formula and all the rest of it, basically they've been screwing everything up. Before then, particularly the Austrians, they understood completely that it was a matter of human action and response, human desires, needs, and also understanding the division of labor. I mean, basically, you go and do something which you're good at in order not to just produce lots and lots of something that you're good at for no purpose, but to sell it for things that you want, which you're not good at making, or someone is better than you at making. And that is the division of labor. And so that means, if I'm producing widgets of some sort, I have got to keep customers satisfied. The customer is king. If I fail to do that, I'm out of business. That is the way free markets work. And governments have tried to replace it because there's no room for them in that at all. I mean, got no role. Their only role is to screw things up. So what they've tried to do is to just reinvent the whole system so that they do have a role. And, they say, right, DK, you don't look too well. I'll give you a free hospital pass. or here's some welfare, so you can enjoy yourself, or vote for me, or whatever. So that's what it's come to. Government has tried to create a role for itself. It has done so by becoming a welfare state, doing the things which we should be doing for ourselves. And eventually, that system's bound to fail and fall over. And I think that's what we're seeing. And incidentally, the old mantra that, the dollar expresses the full faith and credit in the US government. Yeah, it does. Yeah, and nothing else. So when the government fails, the currency goes too.
Yeah, that last point you made, you put it in the positive, but I remember G. Edward Griffin, the first time we interviewed him, putting it in the negative. He says, with any government that wants to take on the complete and total control of your life and sustain itself at your expense, first you see the cheese, but later you get the trap. And that's the point is, it all looks good until it becomes mandatory and compulsory, and then the tables turn.
Yeah.
Well, Alasdair, we have a lot more questions we're not going to have time for today, but we're grateful for your presence here. We absolutely will have you back on soon. We've been speaking with Alasdair Macleod, the head of research at goldmoney.com. Alasdair, any other tips about how people can follow your work?
Yes, goldmoney.com and research, insights. I write one every Thursday. The one which I've put in today, which will be published very, very soon, it'll already be out by the time this broadcast is out, I guess, is a pretty deep dive into the economics of trade. So if you like to get your brain working, have a look at that. You might enjoy it. And I also write a market report, which is published on Friday. These are both published sort of afternoon time EST. But the market report might be quite interesting, actually, I must say, with the breakout. I don't know what I'm going to write yet, but I'll see what happens tomorrow morning.
Plenty to write about, I'm afraid. Well, very good. Alasdair, thank you for joining us.
Very much my pleasure, DK.
To acquire gold and silver, just go to libertyandfinance.com. When the main site comes up, click on Bullion Sales. That's libertyandfinance.com, Bullion Sales. You'll see my name, Dunnigan Kaiser, my phone number, and my associate, Kaiser Johnson, his phone number, our email, libertyandfinance@protonmail.com.